All right, good morning. Today is January 15th, 2025, and I'm back with another edition of the live show here. And today is CPI Day, right? So I'm sure you saw the excitement this morning about the CPI coming in a little cooler than expected. The year over year CPI at a mere 2.9%, which sounds good. The market reaction was interesting. Market reaction was very interesting. The S&P futures, actually all the futures, just exploded higher, right? And so everybody's thrilled about that, which is kind of funny. It's all about expectations. It's kind of like when a company comes out and beats expectations or whatever. It doesn't matter if they lost money and were never profitable, right? As long as they beat expectations. But that's sort of what, the gist of what's happening with the CPI is because instead of being instead of being upset that, prices have gone much higher over the past few years, and the fact that, another 3%, you might as well round it up to 3%. And quite frankly, those of you that have been around a while like me know that the way that CPI is calculated is probably not extremely reflective of actual cost of living, right? So, and what people fail to understand, except for those of you that listen to this show and have for many years, and people that are sort of in tune with this kind of stuff, know that the problem with the problem with the rate of inflation and 2.9 or 3%, I think it was like 3.2 or 3% core inflation, but anyway, it compounds, and the compounding effect of inflation is what gets me. So speaking of which, I got a couple of little items here that will illustrate what I'm trying to say much better than I can probably articulate it, but here you go. And so since we're in January here, I'm it's a good time to sort of reflect on, the entire year, right? So now that December's over. But anyway, whether this is accurate or how accurate this is depends on whether how much you trust the actual CPI numbers, right? So this is kind of interesting actually, because over the last 4 years you can see that these price increases. And so here's the thing: CPI medical care up 9.5% over the last 4 years. I don't believe that one bit. I honestly don't. Food, food at home, food away from home, those are probably decent approximations. Although, quite frankly, I mean, over the last 4 years, um, if you went back 4 years, pick your favorite restaurant or pick any random restaurant or whatever. I'd be surprised if the actual, menu increases from 4 years ago are a mere, 25%. So it's just interesting to see this. So this is this is based on just the last 4 years and what the CPI reflects. And so, going back to what I was saying a minute ago, whether it's accurate in measuring the actual cost of living is debatable. So it's debatable. But I mean, these are staggering increases. So, I always say it's not the minuscule, you know, changes in inflation, the mere, 3% on top of this and that. It's the compounding effect of inflation that gets you in the long run. And so, prices have gone up. Well, if you take all these prices and look at them, it's staggering, right? And then throw another 3% on top of that, right? So that's how it works. So I found this cool little chart. At one time, a long time ago, a couple of years ago, I actually I saved this chart and then I was updating it manually myself. This very exact same sort of graph here. This is pretty cool because what you got here is, 2, 4, 6, 8. You got 10 years, 10 years of official CPI. So there you go. December came in at 2.9%. What's really interesting about this, well, there's a lot of interesting things about it. I could stare at this and think about it for quite a while, but um, you remember the whole COVID-19. There's 2019. The whole COVID-19 thing started, the pandemic, right at the beginning of 2020. But if you look across the year-over-year inflation numbers, they were minuscule, and it wasn't until mid 2021, like spring of 2021, that inflation really took off and started getting ridiculous. And then of course, look at that number right there. 9.1% in July of 2022. And so look at 2022. This was when you start taking, numbers like this and compounding them, there's where the big problem came in, right? And so another thing to think about is, right, so there's the first print over 2%. March of 2021 was the first time that inflation went over 2%. The Fed's inflation goal, right? That's the Fed's goal is only 2% inflation. And so look how many months, year over year months, that inflation has been above the Fed's goal, right? I mean, it came close a couple of months ago, but this is staggering. Anyway, here's what I was thinking about. If you start way back here and you say, okay, something was $100, and then you add 1.6 to that, then if you plugged all these numbers into an Excel spreadsheet, over this amount of time, what you'd find is that, prices just keep going up and up and up and up. And getting back to my point, the Fed creating trillions of dollars to deal with the pandemic back here resulted in all this inflation that we've seen since. And they still haven't been able to get it under control. And so, my next chart, I brought this, I think, last week. Basically, this is the rate of inflation. And the funny thing is, when they say inflation, what they really mean is the rate of inflation, right? Because this is the rate of inflation, but this is the compounding effect of inflation. And of course, it just keeps ticking up. The further back you go, the worse this looks. I mean, heck, this only goes back to December of 19, and that doesn't even include, the last few prints. Looks like it goes to August or whatever, but anyway, so, the US CPI compounds. It compounds and compounds, and so, you add another 3% onto it and 3% onto it, and it's a mess, right? And what's even more ridiculous is that God forbid this, prices ever go down, because that means that the economy sucks and we're in a recession. Prices only go down when you have, recessions and depressions and people can't afford to buy stuff, so companies have to cut prices. So it's really a pickle. And, last thing I want to mention about it before we go to the charts here is the fact that us old school economists know throughout all of history, the history of money, that inflation, as they like to say, is basically a result of governments and or central banks creating money out of thin air. And that's why, that's what causes inflation. So basically, you have a certain amount of money supply, and then you get a crisis that comes along, And in order to help deal with the crisis, the central bank creates, trillions of dollars out of thin air. Well, that just waters down the purchasing power of the existing money, right? And so that's what it's all about. And I mean, that's been going on all throughout history, ever since the invention of money, basically. And so I mean, I think I mentioned this last week. We had some family in town for Christmas, and they were talking about how the price of everything has gone up so much. And in less than a minute, I explained to them that, the reason for that is all the money that was created essentially out of thin air to deal with the pandemic. And so it's like, the PhD economists at the Fed absolutely had to know that what they were doing, and so they pretend that, they pretend that, and obviously price increases, a few years back were maybe a little, were maybe related to supply chain issues and that type of thing. And so that's what they like to blame it on. They love to blame the inflation on everything except for the fact that, you know, the, they create more money out of thin air, which waters down the purchasing power of the existing money. So that's where we are. And so anyway, the stock market is one of the ways that people attempt to keep up with the loss of purchasing power, right? So, in theory, people that have invested in stocks have done very well and have outpaced inflation, I suppose. Considering how much the market was up last year, I'd say investors have done pretty well. We go to my weekly chart. One thing I wanted to point out real quick here when we look at these charts, this always gets me. Um, look at the price, the candle today on SPY, right? See that big gap there? That was because of the good news that inflation came in less than expected. So look at the gap and look at what the candle looks like. Now let me switch to the S&P. Notice the difference as far as the open goes, right? So the S&P looks like a totally different candle. The gap is not as big, and it opened there. There's no little tail on the bottom of it, and it's just straight up straight up hitting the highs. But if I want to really get an accurate picture of the actual gap and what the open looks like today, the SPY is much more reflective, and I'm not sure why that is, to be honest with you. I'm not sure exactly how they calculate the open on the SPX versus SPY, but this is not nearly as accurate of a representation of what the session looks like thus far today as this is. I mean, that's the big gap right there on the SPY. But the funny thing is that I actually like to look at the SPX because it makes more sense to me. The SPY pays a dividend, and that affects the price. And I just, for whatever reason, all these years, I've always in my mind it's about the well, that's not what I wanted. This is what I wanted right here. There we go. So interestingly enough, yesterday this looked a lot different. This is the weekly chart, and of course today is only Wednesday. But this looked a lot different yesterday. As a matter of fact, it looked like it looked like it was going to come down and touch this trend line. So this is pretty interesting too. I mean, there's this huge level of support, which in this pattern right here, I mentioned was kind of toppy looking. So I mentioned that last week and even the week before. I mean, it's pretty clear that we were in sort of a pullback of some nature, and so this CPI number here has kind of really turned things around, right? Let's go back to this daily chart here, and there's that old 50-day moving average. Market's been sort of vacillating above and below it. um, and here's the other interesting thing: this humongous level of support here looked like it was, it kind of held, and then we got that gap down on Friday, right? Pushed back into it, and so interestingly enough, the low right here, and I'm not going to draw the line, but basically this is the election gap, right? And so it's interesting to note that basically the election gap got closed, just a few days, well, a week before the inauguration, basically. So that's kind of interesting. As you can see, there's still a ton of overhead resistance. So the market's been sort of vacillating up and down and up and down, and you kind of see a pattern here. And so with the 50-day moving average overhead and this downward sloping trend line and a series of lower highs, it's going to be interesting to see how this plays out, especially in a few days when the price gets up and gets towards this trend line. Although, it could be, tomorrow, the next day, that trend line. Here's something to pay attention to also is this MACD down here, right? Look at how this MACD crossed. Like, the highs up here around 6100. The MACD has been kind of going down, going down. It's a nice looking pattern, and so consequently, one of two things is going to happen. The market, just by virtue of the market kind of trading sideways, eventually it's going to run into this trend line. If all it did was just sort of chop around sideways, it's going to run into this trend line. But a break of this trend line at the same time that the MACD is crossing up, and then I think, this round number, S&P 6000, is a pretty big hurdle. And so, hey, new administration taking over, lots of changes coming. It's going to be extremely interesting to see how it plays out. And as I mentioned last week, if y'all recall, um, from the last time that the Trump was running the administration, basically his entire proxy for how well the country is doing was the stock market, right? And so, he would talk about the stock market literally on a daily basis. He was watching the tape. How are things going? Well, the stock market's hitting record highs, and so it's just kind of funny because this time around, I mean, we're within a couple of percent, a few percent of the all-time high, and so this thing needs to keep going higher for him to be happy. And as you recall, the last time Trump was president, he was like really hammering on Jay Powell to lower interest rates, lower interest rates. And as you recall, he said the Fed is insane for having these high interest rates. And so, um, and the funny thing about it is that just recently, um, I mean, just recently here, and part of this sell-off that we just saw prior to today was the result of basically this last Fed meeting, right? Look at this last Fed meeting here. This big gigantic down red candle when the Fed basically said that they're going to most likely pause cutting rates. And, the market was kind of bouncing around sideways up near, 6100 and not really doing much. There was no excitement. And then the very last Fed announcement, they cut rates and basically said that they're on hold now, and that caused a huge day of turmoil. The indexes at one point where I think they were down a couple of percent, and look at this: the S&P is up 1.8% so far today. These are big numbers here. These are extremely big numbers. Anyhow, pretty interesting to note. It's tempting to draw a trend line right there across these lows, right? And they say technical analysis is voodoo. Hey, look at, they're practically parallel, right? I see a lot of people, they'll, in the old days, I would just duplicate this trend line and drop it there, but that's a parallel trend line. Let me save all that. Um, yeah, so there you go. There's your bull channel. Going to be extremely interesting to see, what happens in the next couple of weeks with, price attempting to come up to the top of this channel and break out. That MACD's looking, everything about this is actually looking fairly bullish. Other than all this overhead resistance, it's got to chew through tons of overhead resistance, around 6,000, say. Sometimes it just blasts right through it, right? You get overhead resistance like this area back last October. That was overhead resistance, and then for whatever reason, I don't even remember what this was, but the market dropped and then just ripped right through it without looking back. Took everybody by surprise. This is a super unusual pattern. In the old days, I would go back and, my curiosity would get the best of me. And so I'd go back and I'd search the news for, what exactly was going on this particular day here. And then, of course, this day. There had to have been some big news events that caused this sort of island reversal here. So that was kind of interesting. Real quick, what else do I want to look at? I want to look at the price of oil because this is sort of interesting. Let's go to a weekly chart on oil. Here's something to keep in mind, right? And, these CPI numbers, the CPI numbers obviously are hindsight, and the price of oil, while it's not as, quite as important as it used to be back in the old days when I was young and the economy actually moved on trucks and cars, right? Um, but here's the thing, $70 oil is one thing, $80 oil is another thing. And so this is inflationary. I mean, this is a weekly chart, and every time the price, I would say anything, $70 looks like a pretty good equilibrium spot. It kind of looks like, I mean, going back a couple years here, this is 2021. So over the past few years, $70 it's kind of like, the floor almost, but it's a pretty good equilibrium spot. Well, here's my point is in between 70 and 80 is reasonable, I suppose, acceptable, but the fact that we just got CPI in hindsight while the price of oil has gone from 70 to, look at the number up here, 76. The closer it gets to 80, then all of a sudden it becomes a little bit of an issue, potential issue for inflation going forward. And, there's talk on the street, rumors that inflation, it's not actually rumors. If I went back to, I forgot to point this out on my little CPI chart, the rate of inflation is actually picking up like the past few months. And I believe that's why the Fed is noticing that, right? And so the last thing that we want here is the price of oil to head back up towards 80 and or over between 80 and 90, because that's potentially inflationary. So there you go. Real quick, let's look at the old VIX while we're on a weekly chart here. I don't put a whole lot into the VIX, to be honest with you. I've never been a VIX person. Some people swear by it. Well, of course, the VIX prior to today, I guess I need to go back to a daily chart on that. So, yeah, I mean, a couple of days ago on Monday, things were looking pretty rough, and the VIX was over 20 and that type of thing. And so, look at today. I mean, VIX down 11% here. Um, So, VIX over 20, market's volatile, but the volatility, there has been a lot of volatility in this market here. Um, yeah, VIX, big loser today. Last thing I want to look at here is, and this is the thing that everybody, let me go to a weekly chart here. This is what everybody's concerned about is the 10-year yield. And there we go. You can zoom out here to catch this low here. Um, yeah, the 10-year yield. And so basically, higher interest rates in theory, if you didn't know what this was, right? If this was a stock, you'd be thinking, yeah, man, this is a beautiful looking, this is a beautiful looking, oh, jeez. I switched to a weekly chart, so I have to go through all that rigmarole, and now I got it in my list twice. But anyway, if this was a stock chart, this is looking pretty bullish. Now there is, obviously there's the high up here. Um, Consequently, this high back here, right, last October was coincided with a pretty significant market sell-off. The biggest, this little rally here in the 10-year yield coincided with a significant market sell-off, and that yield, I guess, is why the market's been so skittish lately. And if for whatever reason, this continues its little sort of, look at this pattern compared to this pattern. And if you're like me and you like to look for symmetry on charts, it doesn't get much better than that. This is a weekly chart, of course. Keep in mind, it's a weekly chart. So the symmetry between now and here is amazingly similar. And the scary thing about that is, boy, when it broke that trend line, I mean, there was, it didn't there was some fits and starts. You see how it kind of stalled around the highs there, but I mean, it made a significant move, percentage wise, extremely significant. And so you got the same sort of thing going on here. So if this 10-year yield breaks out and to new highs and makes a move similar to this, that's going to spell trouble for the market. So I'm not saying that's necessarily going to happen. And this is a weekly chart. Nothing happens really fast on the weekly chart. Look at this. It broke out and then it came back in. And then the next couple of weeks, it meandered around or whatever. And so that's entirely possible. I mean, it could still come back in. So I would watch, I'd watch this pretty closely. But then again, that is the prevailing narrative, is that everything hinges on the yield. The other funny thing is, the head scratcher is the fact that the Fed's been into a easing cycle, and yet interest rates have been going up, which is quite the conundrum. And there's lots of other problems out there. So this is I could go on about the potential for a calamity. And of course, it's been a few shows. I don't even know that maybe last week I mentioned. I got a dozen different of those slides or graphs or whatever, um, that demonstrate how the market is extremely overvalued by literally every metric that used to matter. The market is overvalued, and it's also extremely top heavy based on the Magnificent Seven, right? And so there's a lot of potential for problems. However, I'll go back to, and so hey, just have to kind of take it as it comes. The great thing about this, I mean, to me, all that really matters is, for the time being, all that really matters is, you know, what happens within the context of this particular pattern that we're in right now. I mean, do we break out of it and go on to make new highs? Um, do we go run up towards the top of this channel, up into this overhead resistance, and head back down? It's impossible to say, to be honest with you. And so anybody that pretends they know how it's going to play out is just making stuff up, right? And so there's no need to, there's really no need to predict what's going to happen here. The key to it is reacting to what happens. So it's entirely possible. I mean, every other time that people thought, well, that's over, it's over. I mean, longer term, you still have, and I will leave you with this. So, nice 30-minute show. Longer term, this is all that matters to me. And even though this is very toppy looking, there's tons of resistance. And as far as I'm concerned, the market's in an uptrend as long as it's above this blue line, and the market's in an uptrend as long as it's above this black line, right, on the weekly chart. So think about that. I mean, this would, if for whatever reason the market came down and retested this line, that would literally be like a market crash, right? But the S&P would still be in an uptrend. That's interesting. That's interesting to think about, and especially in the context of like a much go back a few years here. So what you have back here, right? 2020, 2021 is basically, I could draw that blue line up across all these lows, and then you got, a significant, well, I mean, was that a bear market? Pretty close to one. But so, you basically had uh, a significant correction. And so now you have a very similar trajectory higher on the weekly chart, just like, back here. And, a significant correction would or could. I can't even imagine this. It would be like the Great Depression, right? If the market somehow came back and retested this line here. And especially like if you look at this from 2022, I mean, it was from the beginning of the year, 10 months of selling off, right? From January to October. 2022 was a pretty rough year in the market, as I recall. It was just a couple years back, but I mean, 10 months of the market selling off. And so, a lot of participants, and there's so much animal spirits these days in the market that I almost, part of me thinks that what this market needs is a good old-fashioned, sell down to this trend line to rein some of it in. But that obviously doesn't mean it's going to happen. Although in the back of my mind, as I mentioned yesterday, I can't help but think that there's um, there's potentially a nefarious agenda out there to pull the rug out from under this thing, um, because Mr. Trump is disliked by a lot of people, and it's not just me that knows that the stock market is his proxy for how well his administration is doing, and so well, that's for another discussion. But I did mention it, and I just in the back of my mind, it's still out there. So we'll have to see what happens from here. So as far as today goes, hey, it's all sunshine and rainbows because inflation is a mere, let's just call it 3% year over year. Um, Even though that doesn't make me feel a whole lot better because that's just 50% more than the Fed's inflation target, which they haven't hit in years. And of course, 3% compounded on top of the higher prices that we're paying now is not ideal. So I will leave you with that, and I will see you back here, same time, same place, next week. Oh, and by the way, if you missed any of the show, it's available for replay at investingsystems.com. I leave the prior week's show up each week until I do a new one. And so there you go. See you next time.